If I had to look at these soaring stocks today from scratch, knowing what I know about AI infrastructure, memory shortages, quantum hype, space contracts, fintech re-ratings, and the kind of market where one earnings report can turn a forgotten ticker into a rocket ship, I would do almost everything differently. Most people think this is about finding the next hot symbol before everybody else sees it, but that's not really what this is about anymore. We're living through a market where the story underneath the story matters more than the chart on your screen. A stock can be up huge and still be early. A stock can be down badly and still not be cheap. And a company can say the magic words AI data center, and suddenly everyone forgets to ask the most important question. Can this business actually turn attention into cash? Today is Tuesday, May 12th, New York time. Comment below what day and date you're watching from, because I want to know how fresh this move is when you're seeing it. And quickly, support the channel by subscribing and commenting John A.G. Best if you value my content. So in this video, we're going to walk through the stocks that are suddenly getting all the oxygen. Not like a boring list. Not ticker chart, next ticker chart nonsense. We're going to look at the machine underneath the move. The AI layer, the memory layer, the power layer, the space layer, the biotech lottery layer, and the part people keep missing, which is risk management. Because in a market like this, the winners can make you feel brilliant, and then one bad entry can make you feel like you bought the top of civilization itself. Lovely experience. Very educational. So let's get started. Now, the first thing to understand is that the market looks calmer than it feels. You can have a flat index day, a little morning weakness, a little afternoon recovery, and people start saying nothing is happening. But underneath that, there is a lot happening. Oil is still a major swing factor because Middle East tension keeps energy prices uncomfortable. Inflation data is still a market-moving event because the Fed has not been given a clean victory. And the Fed itself is basically telling everyone, we want inflation lower, but uncertainty is high, so don't assume policy is on autopilot. That matters because the stocks we're talking about today are not defensive, sleepy things. These are momentum stocks. They breathe liquidity. They breathe earnings surprises. They breathe guidance. They breathe headlines. So if inflation comes in hot, if oil stays elevated, if rates stay higher for longer, the market can suddenly become very selective. Not anti-growth, just selective. Big difference. Let's start with AMD, because AMD is now being treated less like a normal chip company and more like a second rail of the AI build-out. Based on recently published numbers, the data center segment is now the central engine, with revenue there growing strongly because of server CPUs and accelerator demand. That's important because the first AI trade was basically buy the obvious leader and go to sleep. The second AI trade is different. It's about who supplies the rest of the factory. CPUs, accelerators, networking, memory, cooling, power, racks, optics, all the unglamorous pieces that make the glamorous thing work. So if AMD has already run a long way, what do? You don't have to be dramatic. You don't have to sell your whole position and announce it to the village. But if you have a giant gain, taking some profit is not betrayal. It's hygiene. The mistake is thinking a strong company always equals a good entry right now. It doesn't. A great business can be a terrible buy for 3 weeks. That happens all the time. Micron is the next part of this same puzzle. In the AI era, memory is not just a side dish anymore. It is one of the bottlenecks. Recent company updates described record demand, tight supply, and data center memory becoming strategically important. Translation, the AI factory is hungry, and it doesn't only eat GPUs. It eats high bandwidth memory, NAND, SSDs, and anything that helps data move faster. But here is the warning. Memory is cyclical. It always has been. When supply is tight, everyone feels like a genius. Then capacity arrives, pricing changes, and suddenly the same business that looked unstoppable looks very mortal. So Micron can be a real winner and still deserve patience after a vertical move. Now look at Nintendo versus Electronic Arts. This is not just a gaming debate. This is a hardware versus software lesson. Nintendo is dealing with component costs and memory inflation, and recent updates showed price increases for its newest console in key markets. That tells you something bigger. AI demand is reaching outside AI. It is pushing on the cost structure of consumer hardware. Electronic Arts, on the other hand, is more about bookings, franchises, live services, and execution. If I had to pick the cleaner near-term setup, I understand why the market may prefer the software side. Not because it is perfect. Nothing is perfect. But because it is not carrying the same hardware cost headache. Then we get into the smaller names, and this is where people need to slow down. Everspin and GSI sit in that specialized semiconductor world where defense, aerospace, industrial computing, and memory architecture can create real opportunities. Everspin's MRAM angle is interesting because speed plus persistence has value in rough environments where systems can't just casually fail. But a contract or a defense angle does not automatically turn a stock into a lifetime compounder. It gives you validation. It does not give you scale. Same thing with Aduro. The clean technology story is interesting. Turning waste materials and heavy inputs into useful products sounds fantastic, but pilot stage promise and commercial cash flow are not the same animal. This is where I want to push back on the easy bull case. People love saying the addressable market is enormous, so the company only needs a tiny slice, right? And I only need one tiny slice of the moon. The real question is whether the business can scale before dilution eats the upside. Now, quantum? This is where the market gets weird. IonQ just showed that quantum is not only science fiction anymore. Recent results showed strong revenue growth, a higher annual outlook, and a huge amount of cash and investments on the balance sheet. That is real progress. D-Wave has also been trying to turn bookings into recognized revenue, which is the real test. But quantum stocks still trade partly on imagination. And imagination is very expensive when the market is in a good mood. The bullish case is that quantum becomes a new computing layer over time. Optimization, simulation, security, materials science, defense, finance, logistics, all of it. The bearish case is simpler. Commercialization may take longer, losses may stay heavy, and investors may realize they paid tomorrow's price for technology that is still being assembled today. Both can be true. That's the annoying part. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk about the space and rugged computing names. SIDU and OSS are getting attention because space, defense, and edge computing are fashionable again. OSS has a more concrete rugged AI compute angle. SIDU is more speculative, more volatile, and more dependent on belief. Small companies can become big winners, yes. But the middle part is brutal. That's where they need capital, customers, execution, and time. And time is the one thing impatient traders hate most. Supermicro is a completely different lesson. The demand for AI servers is real. The need for liquid cooling, rack systems, and rapid deployment is real. But trust is also real. If investors are worried about governance, investigations, inventory, cash usage, or possible dilution, then the stock can trade like a business with a parachute tied to its back. The market can believe the product and still distrust the package. Until that changes, rallies can keep running into the same wall. Biotech is even more unforgiving. DRTS and Huma may have meaningful medical technology and important milestones, but clinical stage investing is not normal stock investing. Trial progress is not approval. Approval is not adoption. Adoption is not profitability. Every step has a toll booth. This is why I never like people going all in on one biotech because the story sounds heroic. The science can matter and the stock can still punish you. SoFi is a better business quality debate. Recent filings show strong revenue growth, rising members, product expansion, and better profitability. But the stock still fights an identity crisis. Is it a bank? Is it fintech? Is it a technology platform? The answer matters because the multiple changes depending on the label. The skeptical view is that credit risk and funding costs still matter. The bullish view is that SoFi keeps becoming a broader financial operating system, and eventually the market has to stop treating it like a simple lender. Now the next layer of AI is power and connection. Navitas is tied to power semiconductors, including high-power markets like AI data centers and grid infrastructure. Applied Optoelectronics is tied to optical networking, and recent results showed data center revenue moving sharply higher. Innodata is tied to the data layer, where AI models need better inputs, labeling, workflows, and enterprise support. Qualcomm is trying to prove it is not only a handset story, with custom silicon for a large cloud customer expected to start shipping later this year. This is the part of the AI boom I actually like. Not because every stock is cheap, some are absolutely not cheap, but because the bottlenecks are becoming clearer. The market is starting to understand that AI is not one chip. It is electricity, memory, optics, cooling, land, software, data, and specialized silicon. The picks and shovels are changing, and the dangerous thing is that investors may be right about the theme but still wrong about the price. Redwire fits the space industrial story. Recent results showed a record backlog and strong demand across space and defense technology. That's not just a dream. That is contracted work. But again, backlog has to convert into revenue. Revenue has to convert into margins, and margins have to convert into durable shareholder value. Space is exciting, but it can be lumpy. Government timing matters. Production timing matters. One delayed program can change the mood fast. One more area people are missing is the Bitcoin miner to AI infrastructure trade. Hive, Applied Digital, and other converted compute names are saying, we understand power, facilities, and high-density machines, so maybe we can repurpose that experience for AI demand. That's an interesting argument, but it is not automatic. Mining Bitcoin and serving enterprise AI customers are not the same business. One is mostly about cheap power and uptime. The other is about contracts, service levels, cooling design, customer trust, financing, and delivery schedules. So when these names run, I want to see actual contracted capacity, not just a shiny investor deck with servers on it. And then there is the photonics group, Applied Optoelectronics, wafer and substrate names, optical networking suppliers. All of that sits inside a real bottleneck. As AI clusters get bigger, the problem becomes moving data quickly, without wasting too much energy. Copper can only go so far before physics starts laughing at you. Optics become more important. That's why these stocks can move like people just discovered electricity. But again, after a huge run, the question is not whether the market is big. The question is how much perfection is already in the price. Inadata is similar, but in software and services clothing. AI needs clean data, labeled data, evaluated outputs, enterprise workflows, and human oversight. Recent numbers show demand is not imaginary. But when a stock doubles or triples around earnings, future growth is no longer a surprise. It becomes the minimum requirement. That's a very different game. So the lesson across all of these is not avoid everything. No, that would be lazy. The lesson is respect the theme, but interrogate the setup. The story can be true and the entry can still be dangerous. Microvast is the warning label. Recent results showed revenue dropping hard and margins getting squeezed. When that happens, the market stops caring about the beautiful long-term story. This is why you don't marry tickers. You own a thesis. And when the thesis changes, you don't sit there writing love letters to your brokerage account. Sony is almost the opposite. Not a tiny rocket, not a quantum dream, not a biotech casino. A real global business with gaming pressure from hardware cycles and memory costs, but also entertainment, music, pictures, sensors, and buyback support. Sometimes the best setup is not the loudest one. Sometimes it is the giant everyone got bored of while chasing shiny, smaller names. So what is the actual strategy? Number 1, separate theme from entry. AI can be real, and a stock can still be stretched. Number 2, separate revenue from excitement. If a company has headlines but no path to cash, size it like speculation. Number 3, don't ignore macro. Oil, inflation, and rates can change the market's appetite overnight. Number 4, take profits when a stock moves too far too fast. You are not required to apologize for surviving. And number 5, build a watch list, not a panic list. Write down the names. Put them into buckets. Core AI infrastructure, memory, power, optics, quantum, space, biotech, fintech. Then ask one question for each name. What would make me buy this at a rational price? If you can't answer that, you don't have a plan. You have a feeling. And feelings are expensive. The people who do well in markets like this are not the ones who chase every green candle. They're the ones who understand what the market is rewarding, what it is ignoring, and what it is pretending not to see. Right now, the market is rewarding AI infrastructure, real revenue, strategic bottlenecks, and credible growth. It is punishing weak earnings, bad margins, trust issues, and stories that need too much time without enough proof. So yes, these stocks are soaring. Some deserve it. Some are borrowing heat from the neighborhood. Some are early. Some are dangerous. And some will probably make late buyers feel like the market personally betrayed them. Your job is not to catch all of them. Your job is to know which game you're playing before the game starts playing you. And just so we're clear, this is education and market commentary, not personal financial advice. I don't know your portfolio, your income, your risk tolerance, or what keeps you up at night. Use this as a starting point for your own research. Think independently and make decisions that fit your actual life, not somebody else's excitement.